Hey, good morning, traders and investors. Welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. Thank you guys for taking time out of your Wednesday mornings to join us. We appreciate it. Happy Groundhog's Day. Punxsutawney Phil did predict another 6 weeks of winter, but we could have told you that here in the great state of Texas. I've got 6 hours of snow forecasted for tomorrow, so that should be an interesting event. But hey, thank you guys for tuning in. We do apologize for not having a show last week. We were unable to meet, but we're back at it. Markets have responded very well to the downside zone of support that we had discussed and had been discussing going back several weeks. And it's starting to look as if the correction may be over. We had been tracking a flat in the S&P. We were tracking a complex in the NASDAQ. It actually looks like the S&P may have also completed in the form of a complex. We're going to get to the charts. Before we do that, let's go ahead and bring in the trading analysis team. Good morning, Terry. Good morning, Alex. How are you guys today?
Hey, guys. Good morning.
What's up, Alex?
Hey, Alex. Bennett, how you doing, man? You ready? You got the firewood ready in case the power goes out?
Hey, I'm ready. We already lost power for like 3 hours the other night, and it was just like 50 degrees out, so I don't...
Oh, man. What was... You don't know what... You didn't even have any weather event cause that. That's crazy.
Yeah, we had some snow. It was clearly something that malfunctioned because of the way it went out. Power went out, came on, out, on, you know, like 6 times, and I'm running around scrambling, turning things off, making sure the surge protectors don't pop. So
I got my update on my Generac. It was supposed to be, well, I ordered it last August, I guess, and they said, yeah, you probably get it in January. Well, now the update is March. So.
Hey, at least you're getting one. At least you're getting one. Those Generacs are actually really awesome. It's a great solution, especially given the situation that we faced last winter with the power grid here in Texas. And you know, I looked into getting one.
I never really thought about getting it for the winter issues, more so the hurricanes that we get here on the coast, or the power, you know, gets knocked out for a week or two. That was usually the whole reason for wanting it, and then. Oh, and then we had the ice storm, and I'm like, well, hell, that's a double reason. So
yeah, you've got multiple.
Let's just hope we don't go through that again.
I was considering getting a Generac, but I live in an all-electric neighborhood. We don't have propane here, so I would have had to have gotten like an external, or we don't have natural gas here, so I would have had to have gotten an external propane tank, but we'll see. Probably won't be able to get my hands on one. So, Alex, how are things in your neck of the woods, brother? Good to see you this morning.
Snow went off, so we have a little bit warmer weather, but they announced it again in a couple of days. So winter is still full on here.
Yep. So the snow came and went, but it's on its way back, huh?
Yeah.
Potentially kind of like crypto winter with the recent bounce that we saw there off 32K.
Yeah, you know, as I said, I think crypto winter started far back in 2021. Many people cannot grasp that, but as you look the sentiment, and as we know, every pretty bullish 99.9% sentiment contains a seed of a bear market or a pause. So we are still in a crypto winters now. Some people said it's starting. Some people, as I'm saying, it's already passing. So we will see who is right on the end.
I love it. You know, for newer Elliotticians, the idea that we can be in a correction and move to a new high, I think, is a concept that takes some traders a little bit of time to grasp. But all right, well, very good. We're gonna take you guys through the indexes. Let's take a look at the S&P. Let's look at the NASDAQ. We'll talk about the structure that we need to see to kind of sound the all clear for the upside resumption. There's been a bit of a debate amongst the technical analysis community over the past few sessions as to whether or not what we're seeing is a, you know, quote, dead cat bounce, just a technical retracement from extremely oversold conditions, perhaps with some short covering in there as well, or is this in fact the continuation move in the wave 5 that we've been after? So boys, I'll be back on the other side. I'm going to take them through the Motive Wave platform, take a look at the wave counts, and I'll see you guys in a few. All right, catch you on the other side. All right, good morning once again, and we do appreciate you guys taking time out of your day to join us. So let's get started. We're going to go full screen here on the Motive Wave platform, one of two key tools that we use here at Trading Analysis. So we're taking a look here at the S&P 500. And when we're looking at the S&P, I'm going to take you right just to start here to a 1-hour chart. So we're looking at a 1-hour time frame. You can see bottom left hand corner of the chart, we have the October low. From the October low, we rally in a beautiful 5-wave trend, completing November 22nd. What we had been looking at in the S&P is the idea that a 3-wave decline was then met with 3 waves back. That 3-wave rally took us into the first few trading sessions of the year. You'll notice the high in the B wave here was actually January 4th. From there, we get a nice 5-wave decline. So at this point, as an Elliottian, as we come off of the January 10th low and start to rally back into the 12th, we could assign a price label that acts as a trigger. Because into the January 10th low, we knew that could have technically satisfied C of an overall wave 4 flat, and this move here could have been upside resumption. When we broke through this trigger point, the January 10th low, that essentially told us to anticipate the move down into wave 4 support. The wave 4 support zone we had noted at equality to its wave 2 counterpart, which happened to have confluence with the previous 4th wave. And I see there's a couple of audio issues. I think that might be, I just got a private message. Terry, if you could let me know if audio is good on your end, I'd appreciate it. So breaking through that 4582 trigger in the S&P gave us, okay, very good, did give us that continuation confirmation, if you would. Into the lows, and we had outlined 4v2 equality. I put out a video as we were coming off of the January 24th low, essentially saying, hey, look, this move back up could just be wave 4, and we could actually go as low as the 38.2% retracement. It does appear as if, based on the magnitude of the move back, that we may have completed this correction in a 3-wave swing to the downside. That would be in line with the NASDAQ 100 wave count, which suggested we've been in a complex. 3 down, 3 up, 3 down to finish the move. Interestingly enough, the January 24th washout move that we had took us to a low of 42.2352, so just over 40 points below what represented equality to the wave 2. Also notice this is all within the vicinity of the previous 4th wave. So for now, based on the rally back that we've seen, we have to ask ourselves a question, and that question is the price action truly motive, as in trend establishing, or is this another head fake move before we do get a push through the January 24th low? Fortunately, thanks to Elliott, we've got some fairly key developments that we can watch and await to help us determine when and where that confirmation development might occur. So, in addition to the technicals, one of the characteristics of a counter trend move such as this is a lack of widespread participation, which is really kind of the opposite of what we saw yesterday. We saw outperformance in Invesco equal weight sectors compared to the traditional sector spiders, both discretionary and tech. Doubled the performance of the XLK and the XLY. We had reports out last night from Google and AMD, as well as PayPal. AMD and Google were favorable. Both AMD had a top and bottom line beat. AMD had very positive guidance. So all of those signs are suggesting that instead of this being a head fake move, that this is probably upside resumption in the wave 5 position that we've been after. And we've been very vocal about the fact that even if we do visit the October lows, this remains a corrective trend. So looking at the idea then that in fact we did complete in the form of a complex, meaning the 3-wave move from January 4th to January 24th did finish wave 4. Looking at this development, taking you from the 195 down to the 1 hour, we'll go down to a 15-minute chart. What we've seen so far from the January 24th low is a leading contracting diagonal met with a 3-wave decline. The 3-wave decline took us into just shy of a 618 retracement of the upside diagonal. And now we have up in 1, down in 2, up in 3. Interestingly enough, if we were to take an equality measurement of this leading diagonal, that level came in at 45.26. Markets hit the equality level yesterday morning, just took a pause. We saw a bit of a pullback, then we consolidated, and then we saw a breakout from the triangle consolidation on the day, and we're seeing continuation here in the futures session. This tells me that we have evidence of 3 waves up, and we've got a zone of resistance between 45.93 and 46.78. It's a fairly broad zone, but it's in that zone that we expect the resistance to give us the confirmation move. So in the event this is upside resumption, we need to see a post-resistance rejection consolidation that resembles an Elliott Wave correction. And it's in that Elliott Wave correction that we'll have the pattern development and confirmation move that we need to sound the all clear and suggest that the upside is absolutely upon us. One alternative worth noting, because this alternate count has made its round, made its round around the financial space on Twitter and other sites. The alternate move is that this 3-wave decline is just part of the correction. And there are some signs, such as new peaks, new extremes and relative strength into those lows that would perhaps support that. But the widespread participation I'm seeing is not in favor of this being counter trend. So if this is in fact counter trend, we've got a 618 retracement at 45.81. Instead of meeting this zone of resistance and yielding a sideways Elliott correction, which we demonstrated in the chart over here, instead of being met with an Elliott Wave correction and a wave 4, this chart would suggest we meet resistance and we see motive rejection to the downside. If we were to get motive rejection to the downside, we could technically visit further support south of the October low, south of the January low, and possibly even see 4,000 in the S&P. This is not the preferred interpretation. This is the back of the pocket alternate that is worth tracking so that you do have context in the event your plan A does not go your way. So for now, certainly looking like the correction is over. We will confirm that with a sideways consolidation in wave 4. Any fourth wave that resembles a correction out of that resistance will imply that the 3-wave move is not being rejected motive to the downside, but it's actually being consolidated for continuation. So that's the S&P. I love the fact that we hit those October lows. We met 4v2 equality, and we're seeing the continuation. Over to the NASDAQ 100. Here in the NASDAQ 100, we had this outlined as a complex. And the reason, and we're on a 195-minute time frame here, I'll go ahead and promote the degree of trend here on the right to match what I showed you in the S&P, just to make it a little bit easier to understand. But here in the NASDAQ, the reason in which I opted to favor a complex as opposed to a flat, which the only differences are the secondary actionary wave that you get would be 3 waves instead of 5. The reason being is when we moved lower into the January 10th low in the NASDAQ and then retraced in wave B, it didn't leave much room for 3, 4, and 5 to complete prior to meeting what we felt would be the dominant downside zone of support. Yes, I will take a look at the Russell for you, no problem. So here in the NASDAQ, the previous fourth wave, the support there at 14,384, you'll notice we did push below that level. If we take a look at that, we were 4.52% south of support. We, however, did have the 38% retracement, so that means we were technically into the low, more like 2% or so, 2.6%. So it does feel as if the NASDAQ has now satisfied that correction. The same is true in that we need to see 1, 2, 3 met with consolidation in 4, and then we'll have the confirmation upside resumption. So that's the NASDAQ and the S&P. There are a lot of positive stock developments out there that support this fifth wave that I've been forecasting prior to the larger 22 correction being technically possible, and I continue to stand by that assessment and analysis. Over to the Russell 2000, taking a look at small caps here. The chart of the Russell 2000 has been tracking a standard 535 Elliott Wave zigzag correction. This Elliott Wave zigzag correction has more or less met support at an appropriate retracement of the third wave. You'll notice here in the Russell 2000, we did breach the 38% retracement, very similar to the NASDAQ. But all we have evidence of is a move down in A, a three-wave consolidation in B, and we can actually call this a completed five-wave move. If we were to break lower again, you could entertain swinging out wave 4 and calling wave 4 a flat, then looking for one more low. But the same is true here in the Russell. That is also true in the S&P and the NASDAQ, and that is 5 waves up from the January 28th low in this instance should be met with a sideways consolidation. Okay? So that's it for me this morning. I'm going to go ahead and jump back over to the team. Hope you guys enjoyed the content. Terry, Alex, what's happening, boys?
Yeah, good analysis, Bennett, there. It's, you know, we're covering all the bases. We've got our preferred degrees, but we have to follow the rules of Elliott. When we see those rules being violated, that's our, you know, that's when we reject, you know, one of our alternate cases. And so we're always constantly keeping valid cases in front of you, and then we will show you where we start to lose conviction in the particular pattern, either due to a rule violation or some other type of alternate look or feel of the wave count that just doesn't meet the proper guidelines and stuff. So appreciate all that you do for us, Bennett.
Absolutely, Terry. Appreciate you as well, sir. All right, he's going to take you through into Optima. We're going to take a look at what's happening on the RRG side, take a look at the rotations, and we'll be back on the other side. Ready to rock,
All right.
Terry?
Yes, sir.
All right, take it away.
Let me get a sip of coffee there first. Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. Can you believe it? January is already behind us. I don't know. I don't know where time is flying. While most traders' eyes were on the FOMC meeting last week's market range was well defined by Monday's price action. And then the rest of the week traded with volatility, ultimately resulting in a positive close for the week. And Friday's price action has possibly started a new uptrend, as Bennett has made you aware. Now, Monday saw the S&P trade as low as 42.22 and as high as 44.17. And for most of the week, the price action stayed within this range, ultimately closing up Friday at 44.31.85, up 0.77% for the week. And similar behavior was seen in the NDX, netting a positive 0.11% gain for the week, and Friday's close at 454.61. Overall, this month of January here in this large rectangle here, you can see overall the S&P declined a net 5.7% in January. The NDX declined 9.5%. The month's range, though, the range of the downside was about 10% for the S&P and about 15% for the NDX. Now, last week, the energy sector once again stole the limelight, up 6.5%. It was followed by technology sector, up 2.38%. Financials and consumer discretionary rose just about 1% each. But staying to the downside were the industrial sector, down 1.48%, the materials sector down 0.98%, and the staples down 0.37% for the week. All right, moving into this week, get that out of the way there. You can see quite a different picture going on here. Now, Monday's price action here saw a continuation of Friday's rebound, with the S&P rallying 1.89%. The NDX rallied 3.29%. Tuesday saw also a continuation of the uptrend, but for both of the indexes, somewhat less than what we saw on Monday. S&P was up 0.7%, NDX 0.62. And here you can see net for the 2 days of trading up 2.59, closing the gap, you know, rallying back here at the beginning of February. Now, I will say that after hours earnings reports are not factored into these numbers here. They think these are close of session yesterday, but we did see some pretty good jumps in Google and several other stocks after hours trading. All right, over here in the sector performance tab here, you can see consumer discretionary is leading. Let me just pull this over here because this table goes along with that. Let's see if this is probably already got some of this morning's trading in it. It looks like, because I'm seeing communication sector. This table over here, I think, includes those Google earnings reports, because it's showing it's up 5.6%. And this is just yesterday's trading action here with consumer discretionary energy. Here's the communications yesterday. It was up about 3%. So you're getting after hours numbers in this table here. All right. So on to the sector leader scoreboard. The energy sector has pushed deep up here into the leading quadrant. Now it's sporting a relative strength ratio of 107.5. Also over here in the leading quadrant, but with much lower relative strength scores, are the staples sector. The materials, the utilities, and the real estate sectors are also in the lead here. There is a little bit of a weakening trend apparent here with the yellow in the real estate. The technology sector and the the consumer discretionary sectors have both pushed down here into the weakening quadrant. But I should note that the XLK retains this green vector color, because that means it still has a weekly leading price trend formation, while the discretionary sector is seen with a much more weaker trend and precipitously, it's hard to say that word, precipitously close now to crossing over into the lagging quadrant. So we have to keep our eye on this really carefully here, see what's turning in consumer discretionary. In the improving quadrant are the healthcare, the financial, and the industrial sectors, but only the XLF is now showing a blue improving weekly trend vector. The industrial and healthcare sectors remain here, but their price action is kind of seen as range bound and lagging. Therefore, they have their the red color on. Now, the only sector remaining in the lagging quadrant is the communications sector. But we've been tracking a steadily rising momentum in this group for over a month. We are just beginning to see a slight northeasterly turn, and like I mentioned, Google's after-hours earnings report are likely to give the XLC the added boost needed to complete a rotation back up here into the improving quadrant soon. All right, one other thing I want to talk about here. Crude oil topped $88 a barrel, and I know with energy pushing as strongly as it is into the leading quadrant, the energy sector does continue to push through these 52-week highs. Bennett, I've borrowed your red count Elliott Wave structure here and kind of mapped it out. We're getting really close. I wouldn't say we're exactly there yet, but we're in an overthrow area above long-term resistance channels. And you can look at even the standard RSI. We're kind of in overbought territory. So yes, I see further strength in the energy sector, further gains here. And because of where they exist over here with the very high relative strength, I wouldn't be surprised to see momentum start to trail off and then actually get a momentum decline. Now, during that momentum decline, more than likely we're going to see sideways to lower prices in a lot of your energy plays, but that's not necessarily the time to exit all of your energy trades because the relative strength value is so high. If you see the energy sector move dramatically down like the XLY from where it's at up here to here, yeah, this is when you want to start getting concerned about exiting positions that you've got, longer term. So XLY is not looking very healthy, but the XLE could be at a turning point. We'll show you real quick here. You can see ExxonMobil announced really good earnings. Probably, I think, the second best ever. Up almost 7% so far this week, but rising last week in double digits were Oxy, Halliburton, Devon Energy, EOG, Schlumberger, and ConocoPhillips. So you don't see those on this chart at the moment because this is Monday and Tuesday's data. But these guys were, there was some really big pushes in a lot of these energy plays last week. And here is my current weekly rotation. Let's just give you a little bit of an animation effect there. You can see this is quite a volatile group. Okay, energy's not been. It's been one of the most active things for what was once called a non-investable, never investable again sector. I think it's captured a lot of people's attentions. Once again, Bennett, there you go. Give you that little turn. And you can see this is the second time we're pushing back up here into that. And usually the third wave goes up into it. Fifth wave goes up into it. We could finish that fifth wave, and then energy might take another big consolidation loop again. That's all I have for now. I just wanted to wish our founder and former CEO, Todd Gordon, a happy birthday today. He was born on Groundhog's Day. And that dang Punxsutawney Phil, wished he didn't see his shadow, but I guess he did. So back to you, Bennett.
Much appreciated. Thank you so much, Terry. Yeah, Texas winter is like January and February. So it had to extend. But yeah, absolutely. Happy birthday to Todd. And if you guys are curious, his take on earnings, he's going to be on CNBC this afternoon, 1:30 Eastern. It's a good session. Take the opportunity to view that if you have the time. All right, Alex, sir, we're going to pass presenter mode your direction. Let you grab the screen, get set up.
Interesting date for Todd's birthday, like 2nd of February 2022. Lots of twos there.
Eventually, it's going to be 2/2/22/22, but I don't know if we're going to be here to see it. All right, let's see. Screen should be coming your way. All right, you ready to rock?
Yeah, sure. Let's go.
All right, take it away. He's going to take you through macro, and we'll see you guys on the other side.
Hey guys, welcome to the Trading Analysis Weekly Turnaround. So let's look a little bit of macro scene. As you know, we have been tracking this U.S. government 10-year yields. Pretty much the same picture from the last week. If you look the CME Fed tool, you will see that market is aggressively pricing a couple of rate hikes in 2022. Let's see if that will happen, and let's see what will happen with inflation in a couple of months. For now, the picture stays the same. We are still trading in the range here, possibly with one more move up above 2% around these equality levels. And I'm very interested to see what this chart will do once we pass a little bit of this 1.798% where we are trading now. In the case we pass this with a pretty much upside, passing these levels for let's say 2.2, 2.3, we'll have to change this wave count into more aggressive upside up to even 3.3, which I think it's not going to be very well for the much of the assets classes in the world. And that also will understand most likely dollar going higher, which has never been good for the emerging markets. So for now, the same picture for the last week. We are contained in some type of a sideways consolidation above this very huge resistance around 2%. And let's see what will happen. For now, we have this as an A, down in B, up in C. Next meeting is in March. Fed was pretty hawkish last Wednesday, so let's see how that will go for a March meeting, where they are going to most likely cut the total amount of the quantitative easing and actually maybe even raise rates for 0.25 basis points. I think market is already pricing that. But for us, technically, the picture stays the same. We are going to pay our attention definitely around this 2% and a little bit above. And we want to see reaction, what will happen most likely in the March meeting. If we go into the European market, so this is the equivalent, it is the 10-year Bund, a German paper. The rates are moving higher. Tomorrow is the ECB meeting, so watch that tomorrow if we are going to see any change in the ECB policy regarding also some type of tapering, withdrawal of the stimulus, and their projections how the inflation should be handled in the next year. So that will be interesting. For now, the rates are moving up. The price of bonds or bunds are moving lower. We are still within this fourth wave pullback. This might actually turn to be a complex ABC x ABC down to these levels in the next year, 2022. And the wave count still shows that this possible wave 3 highs, this will be the longer wave 4 consolidation, and then in one moment we will see, due to global geopolitical events or balancing of economy, if we go out of the COVID and supply side finally solved, a secular inflationary forces like technology and demographic kicks in and push us again into a deflationary cycle. So dollar index has posted a new high. I still see a 3 waves up. Sometimes these blow-offs, what we have seen in the last dollar move, might actually contain a smaller 1, 2, up in 3, 4, and 5, but I don't think so. I think this will be most likely an ending diagonal, which is going to take a couple of weeks more to solve. Definitely these lows here at 94, 63 will be the crucial one. Once we pass that, we can look that this was actually a wave C, and that we are going to look for a 5-wave move downside and a confirmation that actually the dollar has reversed. But for now, we have to follow this probable path, which we might see signs in the next couple of days. And usually ending diagonals are the patterns which are announcing the end of the current move and relatively sharp reversals. So in that case, from here or a little bit lower, we should see one more push up to 98, a move down in a 4th wave. Actually ending and leading diagonals are the only Elliott Wave pattern which allows, or actually which insists on the wave 4 wave count entering into the territory of the wave 1. So one of the rules in the impulsive waves. So ending diagonals and leading diagonals are allowed to have this overlap, and actually that's why you get such a squeezed pattern on the upside, which actually will mean that the market is tired of trying to push the certain assets class on the upside, and then you most likely when you see the end of this type of patterns, the reversals might be pretty brutal to the downside. So our dollar wave count has been moving pretty nicely in the last year, so we are still going to look for a 5 waves down, and this is a down in B and up in C with this finishing touch with a couple of weeks of ending diagonal moving in this wave C. So let's move to metals. So let's look gold. Gold is still very well response from our possible B wave highs at 786, retracement of this move down. Triangle is still pretty much active. So when you have the E wave, see a 5 waves down in A, up in B, and then a 5 waves down in C. So this will not be an ABC. It will be 1, 2, 3, 4, and 5 for the ABC movement down to 1,731. So our support levels at 1,676. All the triangle as still a possibility are very well for now taken care of, because we are not to that. We will have to go down $120 to actually overlap this important level and actually cancel a triangulation. For now, triangulation is still pretty much alive. And if we want to look for some confusion, the triangle is over, we are going to see post this E wave possibility, a 5-wave move on the upside, small pullback, and then off we go to higher levels. On the more bearish wave count, which is still far away, just a distant possibility, this will be a triangle in wave X. We will see a break of these levels, which I have been talked in a previous chart, then a small pullback, and then a little bit lower levels, but nevertheless, all of this is still a very corrective move, and we think that gold sooner or later will actually display these first 5 waves on the upside, which will be a very strong probability for gold continuing higher up to 2000 and even higher levels in 2022 and beginning on either first 2 quarters in 2023. As regards of silver, silver is still following our path on the downside. So we are looking for one more move lower, and definitely this B wave showed a nice drop to the downside in 5 waves. So most likely we will have a move below this 21 just to spook the markets. And then we expect a reversal. So 5 waves up, ABC for WX, or some type of a triangle still possible here, and a little bit of movement lower down to 18 levels, from where we will expect a reversal on the upside. So by the way, this consolidation in silver and gold is pretty much long in time. This is actually going on from almost June, July 2020. So almost a year and a half, we are just trading sideways, or as Terry likes to say, we watch the grass grow in these 2 markets. They're basically going nowhere. But during to the experience that we have looked so many times, this type of patterns, usually when you see this accumulation of energy in neither direction, one break on any side will be pretty much explosive, and we think that this time this side will be on the upside. So let's switch back to cryptos. Lots of developments in the crypto space. I will show you one chart that I think might be interesting, and this is the a longer term chart of the Bitcoin. So also, I don't know if this is the end. Of course, we are looking for a triangle or a flat or even something more complex. In that matter, sometimes you can see a couple of different forms actually getting together, connected with this X wave to form some type of a 4th wave correction. As you can see, the volumes or liquidation volumes, or actually the capitulation volumes that you have seen before on every major low on the Bitcoin are not present here. So we still didn't see this throwback liquidation and the volume spike, which from some part or some reasons should be expected if you want to see the tradable low. We still don't see that. I'm still going to stay with the triangle, which I will show you on our multi-wave, but I have a couple of other forms. I'm pretty much watchful, and current recovery doesn't look so convincing. You don't have a clear 5-wave recovery on the smaller time frames. On the multi-wave platform, we are still looking this potential C wave. Our fib ratios was holding nicely this potential WXY. We have equality, but the move on the upside is not so relevant still to account as a full recovery. We need to see 5 waves up above 40K in this A wave to keep this still D wave alive. So far, this is not so convincing. So I'm still juggling between a couple of these things. 30K is definitely most important support level. If we break that, then the things might become tricky for the cryptos. As long as we trade above 30K in some type of consolidations, I will give it a chance that we might actually go further on the upside in this possibility, in this D wave, crossing this 40K on the upside one time more. So 200 moving average on the daily is around 48. Which will, in the case we move up, will be some type of resistance in this wave A. And also, if you look a weekly chart, this 200 moving average coincides with this 22K levels with this base channel. So I think it's still a wait and see time on the Bitcoin. No sudden moves, no trades yet. To catch this fifth wave on the upside. Crypto markets has been very tricky, and I think judging by the current move on the upside, the market is pretty much scared that it doesn't being washed up again. We are not seeing some decisive buying, and we're gonna go more in depth into Bitcoin and other cryptos tomorrow on Crypto Lab on the Trading Analysis YouTube channel. So if you like to know more about cryptos, join me tomorrow. Back to you, Bennett.
Much appreciated, Alex. Thank you so much for the work there. Yeah, very curious to see where Bitcoin ultimately takes us. I'm still personally favoring the 18 to 22K level and the flat possibility, but if it's the triangle, that absolutely would be solid as well.
Actually, 20K will be, I think, the most pain inflicted, as you said. Markets will go to the most obvious points in a most unusual ways. So I'm very on guard with this couple of options. But 20K will be really a level which not much of the retail could sustain. And even though some of the big guys, I think that average of MicroStrategy is around 30K. 2.5 billion position, pretty large, huh?
Yeah, that would be certainly painful if we did a sell-off down to 20K in that event.
Yeah.
So excellent work. Hey, if you guys are interested in more crypto-specific coverage, please check out Crypto Lab tomorrow morning, 9 a.m. right here on this channel, and then of course check us out anytime, tradinganalysis.com. We'd love to have you trial the services. Speaking of members, we'll see you in about 26 minutes or so here for the member webinar. YouTube viewers, traders, investors, appreciate you guys taking time to join us. We'll be back, same time, same place next week. Speaking of crude oil, put out an update with my take and a chart on crude this morning on our YouTube channel. Check that out as well. Markets are open. XLC communication sector and the semiconductor industry group in tech, obviously leading out of the gate given the move in Google as well as AMD. So solid developments there. See where the markets take us. Appreciate it. Give it a thumbs up. Subscribe with notifications if you did enjoy the content. Boys, excellent work as always.
Thanks, guys. We'll see you next week.
All right. Sounds good. Talk to you guys then. See you, Alex. Have a good one.